Got a real interesting one for you today, suggested by one of my subscribers, so thank you. Spirax Sarco Engineering, a manufacturer of steam management systems and pumps and associated fluid path technologies. They mainly, or predominantly, focus on steam, but they've acquired a few companies that go into several other industries with pumps and fluid path technologies. Very interesting. Growing dividend per share year on year. You know that's one of my favourite things. Yields a little bit on the lower side, and the value, it seems a little overvalued on a discounted cash flow model, and just on par with intrinsic value, which we'll be seeing later on using Simply Wall Street and Alpha Spread. Now, getting all that out of the way, let's get to the easy stuff. Ticker symbol SPX on the London Stock Exchange at 10,858 pence, so you're talking £108 at the moment. Had a height there back in November of 2021 of £17, and the lowest they've been recently is about £91 in the 17th of June. Dividend yield sits at 1.29%. I know a lot of you are maybe put off by lower yields, although the dividend per share is the more important one to look out for on this particular stock. Right, founded in 1888, quite an old company, been around for quite some time, 9,200 employees and a revenue of nearly 1.3 billion. Market cap sits at a cozy 8 billion. Okay, let's go over to their website. Best place to start when you're wanting to learn about any company. And Spirax here is no different. First for Steam Solutions. When you go to the About Us page, you can scroll down, and when you think of steam, think Spirax Sarco. Steam can heat and sterilise almost any industrial process. That's why it's often used in the first choice in so many applications, ranging from food, oil refinery, beer making, drug manufacturing. Steam is known for delivering safe, sustainable and efficient energy. So realistically, steam is used across more industries than you can count, from energy generation to, sanitization of anything. And with that, this company is one of the pioneers and definitely one of the sort of global leaders when it comes to such technology. Let's see. Steam Advice, they have a hardworking team of 1,300 steam experts. Yeah, not the gaming platform. No. This is real industrial processes at work. Now, they manufacture, they deliver everything, all products, and we can see here what their products are. Now, a lot of you might not know what these are, but I think it's always interesting to have a wee look-see over. Boiler controls and systems, clean steam, condensate and heat recovery systems, heat transfer solutions, flow metering, controlled systems, humidification, steam traps, compressed air, isolation valves, and pipeline auxiliaries. Now, industries, they are across, as you can see, nearly every single one of them. And to be fair, most of them do use at least some of these. In terms of the general public, a lot of you have maybe never come across this company, which is fair enough. It seems more on the industrial side of things, but they are just about... It does get a lot better, and where do you see their balance sheets? It gets really interesting really fast. Now, I'm going to actually jump over here to their investor section. This is where it goes into the Spirax Sarco Engineering PLC page. Goes into all the investing side of things. You can find everything you need here. Bit more about them. They're a multinational engineering group, which actually comprises quite a few companies. We'll see them later on here. World-leading industrial and steam systems. Now, the electric thermal solutions was actually companies they had only picked up in 2019, pre-pandemic. And then their fluid path equipment, again, recent acquisition to my knowledge. Businesses, there we go. Let's have a wee look here. We're going to go over to their businesses. As we can see, they have their steam side of things. So that is the Spirax Sarco and Gestra. That goes into energy, water use, quality, for products. Because as I said, steam is very good at sanitization. We can go over to their electric thermal solutions. So Chromalox invented electrical heating technology 100 years ago when the company's founder invented the heating element used in the first electric iron. There you go, bit of history taught there. Thermocokes, which joined the group in 2019, has been an expert designer and provider of electrical heating solutions for 60 years. Then there's Volcanic, a European industrial electric heating company established in 1973, them also joining very recently in 2022 as Europe's largest supplier of bespoke industrial electric heating solutions. There you go. Let's go down here. Now, let's see. They have a 13% operating profit margin for obviously their electric thermal solutions, making up 181 million of their general revenue. Going over to their steam specialities. Yeah, I got it right the first time. 750 million and 23% operating profit. So clearly on the steam side of things, that's where a good chunk of their revenue and their profits are being made. But it's good to see them expanding into other industries. Watson and Marlowe, they are fluid technology solutions for the biotechnology, food and beverage and chemical sectors. Okay. Pumps in the fluid path technologies can be found wherever safety, accuracy and reliability are critical. Aflex Hose, FlowSmart, Aseptco, Bio or IoPure, Massasign, Process Pumps, Flexicon, Bredel, Watson Marlowe and Watson Marlowe Tubing, Pumps and Fluid Technologies. They make up 408 million at a whopping 36.7% operating profit margin. That's impressive. This must be some industry to be in, to say the least. Made up of 10 businesses, Watson Marlowe are. Does it say when they joined? I think it wasn't too long ago they joined. But yeah, that is 3 large spanning industries. Now, what does that all equal? Because we want to see stats. Jumping over to Simply Wall Street, one of the many websites that I use to scan through any stock. You can see here they have a wee snowflake analysis. Let me just talk through anyone relatively new. It goes over the valuation of the company, taken into account against its peers, industry and forecasted cash flow. Goes in and scores them out of 6 for their future growth, their past growth, financial health and dividend. Now, as you can see, they score 4 out of 6 in quite a few of them and 6 out of 6 in financial health, which means they have a basically flawless balance sheet. Strong dividend, strong future, strong past. That's all great. The only thing they're failing on is value, and we will look deeper into that. Risk-wise, very rare we see this where there's actually no risks. Not that there's no risk. There's always risk to invest. This is not financial advice. I have to say that anyway. But they are a bit down. They're 28% down on the last 12 months. Could be a few reasons for that. So let's keep on going. They recently increased their dividend and they were seeking acquisitions back in April of 2022. Going through a bit of the news here. They upped their dividend. They acquired Volcanic very recently, as you can see there, for a cozy 260 million. And then they entered an agreement to acquire Durex Industries. I don't think that's what you are all thinking. Who are Durex? Does not say who Durex are. Anyway, that is yet another acquisition that they are competing in. Oh, it was only in the 29th of September. They're very recent. Let's see. Going down, their valuation is where the kind of it tanks, but it's not for the reasons you think. I don't know if it's been put up against the right or the correct peers, so I always look at that with a bit of a grain of salt. Industry wise, they're 35 times now, because they are such a giant in the steam industry, and because there isn't an exact direct competitor to compare them to. I don't know what we can say about this, but earnings is 222 million and market cap sits at 7.78 billion. So very impressive. Future growth is where it starts to get really good here. 11% forecasted, and free cash flow again is also to increase. Past performance, Back in 2016, they had earnings of 96 million, revenue of 667. As of today, 1.4 million, 222 in earnings at a 15% profit margin. Free cash flow, again, quite high and growing. Down to their financial health, everything is coming up pretty rosy for them. Long-term assets and short-term both cover their liabilities quite nicely. And then, as you can see, the blue there, their equity growing year on year. Their debt has actually shrunk most years. And cash and equivalents, again, growing as well. So everything, interest payments, debt coverage, all in the green for them. Dividend. Now, where does it not score well? It's not notable and it's not high. They may be true. However, it is stable, it is growing, and it's well covered in both earnings and cash flow. 1.29%. Market's bottom 25 is 2.1, top 25, or the industry average for them is 2.3, but they are forecasted to grow in a couple of years. Now, where would I see this fitting in certain portfolios? Well, if you wanted to grow your dividend per share, perhaps this would be a company if you were looking for an extremely long-term hold. Of course, for most dividends, you are looking for that. But this one would be very niche, fitting certain portfolios, starting off with a much lower yield and growing over time. Maybe if they were to, go down a wee bit more in value, you could pick it up. However, it's a bit similar to Games Workshop in the sense of it's got a solid balance sheet, solid growth prospects, solid past performance. I mean, it's hard to say whether the share price would even drop very low, because even after all this turmoil, it is down 28%, but it was kind of dropping over the year. And in the past couple of weeks, it hasn't shifted too much, and it seems to actually be recovering. Things to consider. In the next couple of months, they will certainly be on my watch list because I would love to see where they end up. But it definitely, I'm sure it would fit certain portfolios. There are some people out there that like the lower yield in the much safer companies. And to be fair, because they are doubling their dividend per share, it would be a perfect fit for certain portfolios. Down to ownership, there's been a lot of insider buying as of recent, and I know a lot of you say in the comments that you love seeing these types of things, and I get it. It boosts some confidence. You see shares sold, what's going on? But when you see people buying, and usually directors, they are clearly very much confident in the company. Going down, institutions own 93%. Now, the top one being BlackRock and their friend Vanguard sitting down in 7th place. 6th? No, 6th. Can't count. Can't count today. Okay, another wee website that I use for checking out dividends is Dividend Max. Over here gives you all the information, wee summary of it, saying when it's going to go X and for how much and when that'll be paid. Tells you about the previous one and tells you how many they pay per year. In this case, it is 2. They seem to be playing a final and interim, so the final seems to always be higher than the interim one. I'm guessing that's been the way they've always done it. Yep. So final one's always a bit higher than the interim, and that seems to be the pattern. Lovely wee chart here they've got showing from 2012 all the way to 2021 and obviously 2022. They've been growing their annual dividend. In fact, it is basically near tripled. Probably by the end of 2022 it will have tripled from 2012. So, a lot of rosy good things going for the company. If you had 100 shares, you'd have got a payment of £42.50. Of course, that would involve you spending nearly £10,000 to get the payment of £42, which means over the year for 100 shares, let's see, 108 times 100, 10,800, you would have got £150 this year for that, which, to be fair, a lot of you can look at it. Maybe it's a hedge against inflation. Maybe it's a good place to put it. Again, no financial advice, but it sounds pretty good, doesn't it? Okay, over to Dividend Watch, yet another one that I use mainly for tracking my portfolio and dividends. It's also a good wee tool for analysing any company. Again, symbol, exchange, sector, gives you a wee breakdown of exactly what they do, quite in depth, good to see. And then you can go over to dividends, where again, it gives a similar chart except it's displayed slightly differently to Dividend Max. You can see obviously the higher payments at the start of the year and the interim ones slightly less. Over the last 10 years, an average of 9.07% growth year on year. Perfect. Okay. Stock analysis gives it a 8.7 for their dividend safety score. Everything seems to be quite good in that one. Fundamentals, 2017, as you can see, they've been growing their net income, their net income actually went down 2018, rising again 2019 and again in 2020. Quarterly, we can see how it was going more recently, and it seems to be hovering quite usually at about sort of between 50 and 60 million in net income, and then quite good cash flow as well. Okay, alpha spread gives intrinsic value. Now, what is intrinsic value for anyone that is relatively new? It is a way of calculating the so-called value of a stock. Obviously, it's nearly impossible because markets and just general trends control the price of a stock, but it is like the discounted cash flow model that simply Wall Street uses to get the valuation. This is simply another way of looking at it. Now, as you can remember, in the valuation of Simply Wall Street, it was about 28% overvalued. In this case, they reckon it's about 3% overvalued in the base case. Worst case, it's 20% overvalued, and it should be more towards the £87 mark. But best case says it's £15. Interesting part about that is we know this stock has made it to £15 before. In fact, this stock has made it to £17 in the past. So, I usually like to see is the best case, has it been achieved, and it has been achieved before. Now, that's still, a lot of them are saying that even at this, in base case, it's still an overvalued stock. For a lot of people, it might put you off, might actually, for some people, they might think, it might be, a fantastic stock to pick up. All comes down to personal preference and, again, your own portfolio. Over to Trading 212, this is the brokerage that I use. I use it mainly because there's not a lot of fees as I buy a stock here and there, and for a lot of brokerages they charge per transaction, and I ain't about that life, so that's why I use Trading 212. And links for all these websites are in the description. Some of them are affiliates, some of them aren't, but they're all free to use tools. They all do have premiums or premium versions, but I show you as much as I can with all the freebies. So they were £17, so £15 they have achieved before, and then obviously dropping to about £92 back in June. Definitely one to look out on. I think it's a really interesting industry, one that I hadn't even thought of looking into. Again, thanks for the suggestion, of course. Let me know what you think in the comment section below. Is it in your portfolio? Were you looking at it? What's your thoughts on it? Love a discussion about it. Let me know, and we're going to have a wee chat in the comment section. If you enjoyed the video, be sure to drop a like, and of course, have a fantastic evening, morning, afternoon, wherever you are. And I will catch you all in another video or another portfolio update or whatever. So, see yous. Thank you.